Welcome to Real Estate Radio Live, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much, much more. Now, here's your host for Real Estate Radio Live, Tom K. Wilson.
So nice to have you back with us today. Thanks for tuning in to our Real Estate Radio Live program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for the 2 p.m. Wednesday edition of Real Estate Radio Live. It comes to you daily, Monday through Friday at 3 p.m. and on Wednesdays and Thursdays at 2 p.m. And my show's also broadcast at 9 p.m. So that would be great. Anytime you can catch us live. If you can't, please go to tomwilsonproperties.com and look up the radio shows and look at the podcasts and see if the topics that are of interest to you. And you can play those podcasts. We've had the pleasure of broadcasting these programs for about 2.5 years, and we've had a lot of wonderful guests like we can do again today. Their topic today is investor loans with Dave Beach out of Dallas, and we'll be with them in just a moment. If you go to tomwilsonproperties.com, we have a newsletter on economics as it applies to real estate that you can get weekly with a quick 1 or 2 minute read and get caught up on what's going on out there in the world without trying to digest all the other material that comes through. Nice little summary. Also, we have a report available from High Tech to the Heart of Texas that shows my methodology of how I go about selecting the best metro and the best products to invest in. We always welcome your questions, welcome your suggestions for topics, and we're always available for consultation if you have questions about real estate and your portfolio and what to do next about that. So investor loans is a subject a lot of people, almost every client of ours on Wilson Investment Properties ask us, is it hard to get loans for investors, and if so, does it make any difference who I go to? So I thought it was time to have a little bit of a update in that regard, and we have someone that's been working with us for quite some time that we refer a lot of clients to. His name is Dave Beach with Cambria Mortgage, and Dave has been in this business for 12 years. Prior to that, another techie that came over to real estate. He was in the telecommunications business with an engineering background, and he was with the U.S. Army for 6 years before that. So we always like folks that have had some breadth of experiences, and we like to work with folks, as I've often told you, that it's very important you select your team, to select your professionals who have a lot of experience in exactly what the arena that you're in. So if you're looking for a agent to work with and you're an investor, make sure it's an agent that works mostly with investors, insurance, all the professionals, tax, and that's no exception to lenders. Lenders are quite different in their areas of specialty and experience, and you want to work with somebody that has a lot of experience working directly with investors like Dave does. Dave, welcome to the program, and it's nice to have someone to work with like you that has that works with investors a lot. How's the investment world of loans these days?
Well, so first off, it's an honor to be on the show, Tom. I very much appreciate the invite. So a couple really great pieces of news. As everyone's well aware, the cost of money out there has been low for a long time and continues to be low. So, it's a great time to jump into the market in terms of the cost of entry. And then the second thing, which is really a trend that's starting to emerge here in 2015, is the introduction by a number of non-bank entities of financing solutions that will help support investors going forward. for a long time, the only game in town, or primarily the only game in town, was the conforming market. The market really dictated by the Fannie Mae and Freddie Mac guidelines. And while that's your lowest cost of money, certainly the guidelines and the rules for people who have been through the process sometimes make you scratch your head. So I think as the marketplace for solutions expands, you'll start to see some pretty interesting products and pretty interesting options that start to avail themselves to the market.
Okay, so more private money that's not planning on selling it off to Freddie and Fannie.
That's correct. Yes, sir.
Okay, all right. Let's talk about. Let's start off with kind of the global view here and how the market trends are going. Talk to us about that and the cost of funds and CFPB impact and so forth.
So certainly, in terms of where we're going from this point forward, a lot of it's going to be driven by, certainly what the Federal Reserve decides to do, but also by the perception or the anticipation of what the market thinks the Fed's going to do. So, I know they're met or Janet Yellen briefed Congress yesterday and is again on the Capitol Hill again today, and I think the language is nuanced and changing a bit in that they are anticipating some increase in rates in the latter part of this year, but certainly that's all subject to how the economy and everything unfolds. But what counters that is the bond market many times reacts, to news on a global basis. And what's kind of, I guess, ironic is that what's bad news in the world, whether it be in the Middle East or whether it be oil or what have you, winds up typically being good for the U.S. bond market. And so when the bond market enjoys, good days on the street, the pricing and rates tend to stay low. So I think between the reserve, is going to be some pressure to force rates up in the out years, but the global circumstances I think are going to anchor that somewhat.
Okay. We'll talk a little. Go ahead.
I was going to say the other thing that overlays all this stuff. So the Consumer Protection or Consumer Finance Protection Bureau, or CFPB, this was an entity that was born out of Dodd-Frank after the financial crisis. And so they've got their tentacles in a lot of financing areas that impact consumers, whether it be mortgages or credit cards or consumer loans or what have you. So they don't have a lot of oversight because of the way they were structured. And so they're kind of they're the unknown as all this goes forward. I mean, certainly banks and non-banks are a little bit looking over their shoulder what CFPB is going to do. But that's another thing that's going to impact the market and the cost of funds as we go forward, because what CFPB does represent to banks and non-banks is compliance risk and management risk, and that's going to have to be priced into the cost of money going forward.
More and more constraints they put on under the label of protecting the consumer. That's always upward pressure on prices, right?
Exactly, and since they're new and there's very little case law in the marketplace, the lenders don't, they can't know for certain what activities are going to trigger, violations versus what are just going to trigger, slaps on the wrist type stuff. So, again,
and are some lenders as a result putting some overlays in place to protect them from potential moving forward issues?
I would say yes, but they're not overlays that we think of, you and Tom think of in the regular sense of guidelines. I think with the lender's response to CFPB impact is really from a risk management perspective. So it may be a general pricing increase that really isn't impacted by specific overlays, if that makes sense.
Okay. Let's talk about QM versus non-QM financing.
Okay. So one of the outputs of CFPB was a concept of a qualified mortgage, referred to as QM. And most mortgages originated by Fannie and Freddie either meet QM or are grandfathered because they are being originated in accordance with Fannie and Freddie. Some very specific requirements, and the early thought when the QM guidelines came out was no one would touch non-QM stuff because the penalty and the risk were just too severe. Fortunately, the marketplace has looked at that, and there's been a number of non-bank entities who have stepped up and will now provide non-QM financing. So what non-QM really means to the local investors that there are going to be loan products out there, fixed rate products that won't have to meet Fannie guidelines. You'll see some products that have no restraint on the number of properties you own. You'll see properties that may allow or non-QM guidelines that may allow you to finance properties, just from an asset perspective. You've got, say, $1 million liquid assets but no employment. In the Fannie world, that could be problematic. In the non-QM world, you'll start to see solutions like that evolve.
What are the sources of some of these non-QM financing? Is this Wall Street money or hedge funds or large financial institutions?
Yeah, I think it's going to be a conglomeration of all. I mean, the non-QM stuff is going to enjoy, higher rates. If you benchmark, say, a 30-year fix for an investment property of 4.75% today, the non-QM stuff might come in at 6 and 6.5. So that's going to attract a lot of money, whether it be directly or indirectly, from those same institutions that enjoyed larger returns on mortgages in the past, whether it be retirement funds, hedge funds, sovereign funds, and I'm sure there'll be activities on Wall Street to try and bundle all that as well.
Okay. We have just about a minute left of this segment here. Dave, you want to talk a little bit about your crystal ball guesses about bond market and to what degree those fluctuations are going to affect the rates?
Well, I like to tell folks, Tom, my crystal ball broke back in 2010. I thought no way we'd be at this level. 6 years after the crash, I thought we'd be back up to what was pre-2008 pricing. So again, I think the economy, what's going on globally, again going back to the Middle East, going back to the Ukraine, all those things I think get thrown into the mix. I don't see any solutions on the international scene anytime soon. So I think that's going to keep our bond market pretty strong, which will again portend, in my mind, will portend continued low interest rates. And I think the international events are probably, in my mind, a little bit more important than the Fed in terms of what's going to drive the rates in the near term.
More of a wild card. Huh? Fed's a little bit more predictable.
Well, I just
than what's going on in the world.
Yeah, I just think internationally people are going to run to safety, which right now is the U.S. bond market. And I think that's really going to keep the bond market in solid shape for the foreseeable future.
Oh, okay, there you are. You heard it. Dave's Broken Mortgage. Nice to have him with us. He's an expert in investor loans, and we'll be back talking some more about that in just a moment on KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
So nice to have you with us today, and so nice to have Dave Beach with Cambria Mortgage out of Dallas, who's an investor's provider of loans, and that's our topic for today. Dave, they gave a nice overview of what's going on in the marketplace in the prior segment. So let's talk about solutions and move toward that. Talk to us about what's available for the investor these days, and talk about just the different kinds of loan products.
Happy to. So, as you're well aware, we support a large number of investors back in the DFW area, as well as little parts down south in terms of San Antonio and Houston and what have you. So, what I tell the investors, I think is good to understand, is that Fannie Mae and Freddie Mac are not the only source of financing. So Fannie and Freddie, the conforming world, conventional world, agency world, great place to source financing because it's the lowest cost of funds. It enjoys the government subsidies and the government backing, so it is the lowest cost of funds. But
if you can get it, take it, right?
If you can get it,
right.
Take
if you can
it,
get it, take it. Yeah.
Right. But by no means.
But don't feel like you're stuck with it.
Exactly. So, in addition to the conforming world, again, where you find your fixed rate products, we do a fair amount of investing with portfolio solutions here in the DFW area. And then the third area, which a lot of your investors will be familiar with, is a private or the hard money source. But I think it's key. All three of these sources have benefits that can apply to a particular application or situation investors involved with. I would tell you the portfolio is very popular because it's quick. It supports both acquisition and rehab. And I have a number of investors who, because of the ease of the portfolio, now really steer clear of the conforming. The higher cost for the portfolio they feel is well justified for the ease of its application.
And is this for short-term or long-term or both?
It can be both. We do have portfolio lenders who have fully amortizing loans. Now, the portfolio folks, at least at this point, tend to offer either adjustable rate mortgages or the 3 or 5 year balloons, which are more, analogous to the commercial world. And then the other thing that's coming online here is the interest in, or the availability of bundled financing or blanket loans, if you will. I know there's a couple of firms here that have some hedge fund money behind them that are now offering the ability to bundle 5 doors or 10 doors or what have you, and whether it's 5 single families or half a dozen duplexes, they don't care. But you now have that ability, or at least starting to have that ability, to bundle loans as well.
And do you have some local providers rather than, I know there's, I think, 5 now hedge funds that were buying houses, and now I've figured out that maybe there's this niche with investors that are fannied out to go that route. So are these, you have some local sources or regional sources that are not the hedge funds as well?
On the bundled side, no. The only sources I'm seeing so far is money that's it's a local entity, but it's funded by a hedge fund.
Okay.
So,
But for non-bundled, non-Freddie and Fannie, you have some local sources.
Yeah, and like I said, the local banks which offer the portfolio really wind up being a great source of funding, and so I would encourage all investors to at least be aware of that. If you ever come across a situation that doesn't fit in the conforming world, the portfolio can really be a sweet way to take advantage of the deal versus having either to give it to somebody else or just pass on it.
Let's just put a couple numbers out there in about a minute we have left in this segment here. We're running about 4.5, something like that, for a Freddie Fannie backed loan for an investor these days.
Yeah, for a 30-year fixed. And so investors need to understand they get to pick the interest rate. I know a lot of folks ask me, what's my rate? So I've got some investors who are picking 4% for 30-year fixed now. I'm not sure it's the best choice, but it's their choice, so I honor it. But I think the sweet spot tends to be 4.5 to 4.75 right now. That's a great spot.
Relative to the upfront cost.
Correct.
Right. Okay. And then on the non-Freddie Fannie, let's cover those numbers in a moment. Right after the break, we have Dave Beach with us today with Cambria Mortgage, a very experienced lender who works a lot with the investors, and he's with us talking to us from Dallas today. Nice to have him with us on the program. We'll get back to investor loans here right after the break. This is Tom K. Wilson on KDOW 1220 AM, the Wall Street Business Network. Stay with us. We'll be right back with Dave in just a moment.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
We're talking about investor loans today, and we have Dave Beach from Dallas with Cambria Mortgage with us, another techie turned real estate arena. And he's been in this business about 12 years, and he's helped a lot of our investors get good products. Dave, we were talking just before the break about how rates are running these days. So with minimum upfront costs, it's kind of ballpark for Freddie Fannie conforming loans about 4.5, which is just unbelievable. When I started really expanding 16 years ago, it was 8.5%, and I couldn't get enough of them. They were just great. People were worried that, oh my gosh, if it goes from 4.5 to 5.5, it won't work anymore. No, not the case. So what's the premium you pay for non-conforming loan these days, roughly, for products that?
Yeah, so if we're looking at comparing conforming loans, and you're right, a 4.5% for an investment property is mind-boggling when you think of years past. But if you go with the non-conforming, the portfolio world, you're going to look at rates that range between probably 6 to 6.5%. Mm-hmm. But one of the little sidelights that winds up being a positive is the closing costs tend to be about 2/3 of what a conforming loan is. And again, that just represents there's less hands in the pie, so to speak, less cooks in the kitchen. So your closing costs tend to be a little bit less, but then your cost of money tends to be a little bit more.
Mm-hmm. Okay. And how about LTVs? What are they doing in that arena for investor loans?
One of the things that's interesting, and this will be really focused on the conforming products right now, is most of the investors I talk with initially come in and their whole mindset is they want to minimize down payment, which is fine. I mean, there's something to be said for leveraging your dollars. But in the conforming world, for folks who have good to great credit, say 740 or above, what most investors don't realize is there's a significant premium that Fannie Mae and Freddie Mac extracts from that product, that 20% down payment product, versus a 25% down payment product. So it's 150 basis points difference. And so on a $100,000 loan, you're going to pay $1,500 more dollars in fees to do 20% down vis-a-vis 25% down. So that's one of the things that I really, it's kind of one of my holy grails, Tom, is to make sure investors understand why 20% is available, understand the cost savings available at 25% down. And if you've got the wherewithal to do 25% down, you'll do a great job of accelerating your return on investment.
And for a conforming investor loan that's going to Fannie or Freddie, you can do the 20% down for the first 4, but as soon as you go from 5 to 10, you have to go to 25% down anyway, right?
That's right. And so on your 5th mortgage, then you're required to take advantage of the cost savings of doing 25% down is the way I kind of look at it. But yeah, you're right.
So, and I presume you tell most of your investors that, hey, until you've reached till you're fannied out, as we call it, you've reached your 10 loans, go ahead and grab the cheap money, but don't feel like you're done then because there are other options, right?
Well, that's correct. I mean, one of the things, certainly some investors like to go the rehab route, and a certain, the products that Fannie and Freddie have are either non-existent or not very friendly. And so, but if you find a great deal that needs some tender loving care that wouldn't qualify for a Fannie Mae loan, that's where the portfolio side or the hard money side comes into play.
Okay, all right. Well, let's wrap up on that note as soon as we get back. We have Dave Beach with us, Cambria Mortgage, with us from talking from Dallas today, talking about investor loans. Stay with us, and we got some more good points in the next segment. This is Tom K. Wilson on KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit reradiolive.com. That's reradiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit reradiolive.com. That's reradiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
Great having Dave Beach with us today from Cambria Mortgage out of Dallas, who is an investor's lender. And we were talking just before the break about the difference in LTVs and how that can get you some advantages Let's talk a little bit more, Dave, about just the loan level price adjustments in general, such as in that example for the break of 75% versus 80%, you're going to get better terms whether it's conforming or non-conforming, right? With a lower LTV. And what are a couple other examples that affect price? I'm sure FICO score is one.
Yeah, no, Tom, you're absolutely right. So the concept of loan level price adjustment, these are factors that Fannie Mae and Freddie Mac dictate to the market. We talked about the LTV example where the equity or the increased equity will reduce your cost of financing. That's because of these loan level prices that Fannie puts on the marketplace. The other big one that everyone is aware of is the credit score, the FICO score, and that's where you see the difference. If you've got a 740 score, your pricing adjustment is very, very small. It's about 25 basis points. If you've got a 680 credit score or 660 credit score, the price adjustment is fairly large. It can be up to 250 basis points. Now, how that impacts the investor or the borrower, that dictates your closing cost. So 250 basis points on a $200,000 loan or a $100,000 loan translates into $2,500 of additional cost at closing versus a guy with a 740 credit score. So people, will see different things that come out, but understand Fannie and Freddie dictate these. They're not dictated by banks or what have you.
And so another way of looking at that would be if you take that difference in money, you could use that to pay down the rate, so you'd wind up with a delta in the rate, right?
That's exactly right. There's a lot of ways to use those, the pricing adjustments. But just so understand those exist, and that's what drives the different pricing scenarios that you'll come across as a borrower.
Okay. Talk about self-employed. Some folks think that they have trouble getting loans. It's going to be hard to get a loan if they're self-employed. But what's talk about that?
So self-employed, I hear that quite a bit. I'm self-employed. I probably can't get financing. So what folks need to understand, the marketplace doesn't treat self-employed any differently than W-2 employees, with one exception, and that is that the tax return is going to drive the qualifying income for the self-employed borrower. So where people get a little bit frustrated or even get in trouble sometimes is those activities, those decisions they make to maximize their business write-offs, their business deductions, so it minimizes their tax liability. Those same actions compromise their borrowing capability. So they just need to understand, they're rushing to reduce their tax liability, and they need to understand when they do that, they're also reducing their ability to borrow. So they need to weigh both options, particularly an investor who's self-employed, which of those are more important, reducing my taxes or having the leverage and ability to finance investment properties. And there's some medium ground there as well.
Okay. Let's talk a little bit about the difference between an investor application and a non-investor, and why it's important to get a broker who knows how to work with an investor.
Okay, so this is always another one of those great areas. There are certainly a lot of lenders and a lot of options, a lot of sources for financing out there. And for investors, particularly who have acquired a number of properties, say 4, 5, 6 properties, there's a lot of moving parts involved with getting an application done at that particular point in time. And so knowing the nuances, knowing the idiosyncrasies of the marketplace of various lenders really lends itself to brokers who have experience working, with the investor niche. Because there are a lot of ways to get from the start to the finish. There's a couple easy ways and a lot of really, really hard and frustrating ways. And so with a broker who's been working the investor niche for a while, we tend to understand where the landmines are and tend to be in a pretty good position to help navigate around those. Certainly not perfect. Certainly can't predict what every underwriter is going to do or say. But I dare say we're probably in a good position for success. One of the comments I get quite frequently is, well, this lender doesn't do X or this lender doesn't do Y, even though Fannie Mae allows it. So the other great thing that's out there with various lenders is these overlays where they take the Fannie Mae guidelines and they add their own restrictions to them for a variety of reasons. But understanding, and those are the real pitfalls, understanding which lenders have what overlays that impact what investors winds up being pretty critical for an investor's success. And again, that's not
And
something
probably more so for an investor than a non-investor. So it's important to have someone like you that knows, okay, which underwriter we go to for loans 5 and 6, and which one we go to for loans 7 and 8, and because of the overlays and so forth.
That's exactly right.
Okay. We've got about a little over a minute left here in this segment. Let's talk about the different financing sources. Talk about broker versus the banker.
Okay. So again, this piggybacks a little bit about what we just talked about. Although in the banker broker world, it's key to understand that bankers, and this can be the big banks or this can be the small banks who are doing conforming loans, tend to have a single source of funding, or at least a single source of funding they're comfortable with, and that's funds from their bank. So they tend to be captive to, what kind of financing their banks prefer, whether it be owner-occupied, whether it be some other niche, maybe it's second homes up in Vail or Breckenridge. But when they have investor requirements that tend to be out of the box or tend to go beyond what that bank offers, many times they'll hit a wall. A broker, on the other hand, again, we have the option to work with a number of different lenders, a number of different banks, a number of different solutions. So particularly in the investor world where things can not always be cookie cutter, we have a lot of different options that most banks or bankers really don't have either access to, or more importantly, don't even have knowledge of.
Yeah, that last one's a really good point, I think. It's great to have access, but someone that may not even be aware of the other options and the different kinds of overlays that they have to navigate through. We have Dave Beach with us today from Cambria Mortgage, an investor's lender who's talking about the different products in the marketplace that are unique to an investor and how it can be navigated if you get the right person on your team. So stay with us, and we'll wrap up with Dave here in a few moments on KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Welcome back to Real Estate Radio Live, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Tom K. Wilson.
Our topic today is the special world of investor loans, and we have an expert in that area, Dave Beach with Cambria Mortgage. He's been doing them for 12 years. It's been nice having you on the program today. Dave, another techie converted over to real estate world, decided to specialize in loans. We got a couple minutes here, Dave, to wrap up. What's some key points you want to leave with the listeners?
Well, Tom, first, it's been an honor to be invited to the program. I'm humbled. In terms of just a couple things to wrap up with, when it comes to financing and working with investors in investment property, always remember equity is key. I'll tell folks here in DFW, if you have a deal that's got equity, we can find financing for you. So if you've got a great transaction, we can help you. Understand that the conforming world is not the only place you can source funds. Again, conforming is good because of low cost, but if you can't get a conforming, don't let the deal get away from you. So portfolio financing, we have some relationships with local banks here in DFW, and they do an outstanding job helping our investors over all sorts of situations. Because portfolio typically lets you do not only acquisition but rehab. And then the third source, again, is the private and the hard money, which has some very strong benefits as well. And Tom, one of the things that when we're talking about terms I didn't touch upon was conforming adjustable rate mortgages. There are a number of investor models that have you selling your property, say after 2, 3, or 4 years of ownership. An adjustable rate mortgage, particularly a 5-year, enjoys interest rates similar to the 15-year fixed, but with a 30-year payment schedule. Your cash flow is great. Your cost of ownership is less. And if you're probably going to sell that property anyway, don't discount that as a really strong option for financing. And then the last point I would make is, we talked at the last segment about the difference between who you choose to work with as a finance officer. And again, one, working with somebody who understands the investor niche is going to save a lot of frustration and gray hair. And then two, working with a broker, you're likely to get access to a lot more options that will dovetail well with your particular objectives. So I would leave you with those 3 key points. I think you keep those in mind, and you'll be saddled for success.
Thanks. And if you're self-employed, don't feel like that's going to be too big a mountain to climb. If your tax returns show an okay income and you've been doing it for 2 years, we can get loans for you too, right?
And Tom, there's always next year's tax returns. So
that's true. Plan toward the future there.
That's exactly right.
Dave, how can if people want more information? How can they reach you?
So I'm actually, I always tell people I'm in West Texas, but I'm in the DFW area on the west side of DFW. Website is CambriaMortgage.net, or you can reach us at 817-498-5098.
Great. Dave, wonderful to have you with us, and thank you everyone for joining us today. It's good input from Dave. It's been a joy working with him. And remember, you can go sign up on TomWilsonProperties.com. Sign up for our newsletter on the economics relative to real estate. You can get a copy of our From High Tech to the Heart of Texas, the methodology that I use on selecting the best metro and the best products to invest in. And let us know your questions, or we're glad always to give you some consultation on your real estate portfolio and where to take that. We're providing houses, and we're providing retail syndication for folks. So if that's something of interest to you, let us know, and we'll be glad to help you in those areas and answer all your questions. So nice, as always, having you with us, and be back with us next week with another guest. And remember, the only thing that matters is what you do next. So plan ahead and make some good decisions. We'll see you next week.
To Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Tune in, log in, download our podcast, discover more at RERadiolive.com. RERadiolive.com.